Good afternoon and good morning, everyone. My name is Michael Grover, and I'm the Qorus Regional Director for the Greater Mekong area, Hong Kong, Singapore, and Malaysia. I'm especially honored to be asked to moderate this, the very first joint Qorus ABA webinar, focusing on key topics for banks. I'm very pleased to introduce Peter, who is today's subject expert and presenter. But before I hand over to Peter, let me please ask you to write any questions you have for Peter in the Q&A section, and we will address these after his presentation. Okay, so without further ado, over to you, Peter.
Thank you, Mick, and thank you everyone for joining us today. And we have prepared together a list of the key trends and developments that we see happening in the climate, environmental, and ESG risk management space. So we will spend first part of the webinar going through all these in an inventorized list of trends. I will be sharing materials that I have collected by delivering these trainings globally on behalf of organizations such as Premia, Risk.net, where I have trained hundreds of bankers on different aspects of risk management and lately also climate risk. I'm closely working with Mick in Qorus as ESG advisor, and I've been talking to bankers around different aspects of risk management and climate risk management for over the last almost 20 years. So we will see collection of all these items coming up in our presentation today. For those who are less familiar with Qorus, why Qorus and ESG? So we have an ESG community within Qorus where we host a number of different events, webinars such as this ones, do research studies. So if you're interested, have a look at the work that we are doing at Qorus, the ESG community. There's a lot of very interesting material. So this is just a list of some recent events where we hosted speakers, debated the different aspects of climate and ESG. And some of them will be coming up as well. So maybe before we kick off, really, I would like to emphasize, and that's what I also do with most of my trainings, that climate risk, it doesn't exist in isolation. It consists of different elements that all come together, and we will be touching different aspects of climate change and climate risk. So, for example, we will start with looking at the risk side, because climate change is the ultimate systemic risk, according to some of the key regulators. Risk element is very important here, but it's not the only one. We're talking also about the transformation that is related to climate change that comes with the risk, but it's not just about the risk. So we're talking about the greatest transformation of our times when we're talking about decarbonization, which is a key element of the climate change risk management. To decarbonize, we need to reduce our emissions. And when we reduce our emissions, we reduce our exposure to transition risk, which is one of the key risk elements of climate change. So greatest transformation of our times, that's according to leading representatives of European Union when they adopted the latest set of laws that are pushing down climate-related requirements on all different aspects of economy, and we're talking about greatest transformation. So what does this mean for us as bankers when our key customers, key companies in our portfolios are going through greatest transformation of our times? So that's the question that we should be also asking ourselves. The biggest challenge banks have seen for decades, as it will completely change how banks operate now. This is not a quote on AI, this is a quote on ESG by the CEO of ING. The biggest challenge for banks, ESG, that is coming with ESG. So we will be touching on that as well. At the same time, it's not just the risk, there's an opportunity. Decarbonization is the greatest investment opportunity of our lifetime, according to the CEO of BlackRock, the biggest asset manager out there. So when we're thinking about investment, we need to think of risks. We need to think of the transformation that the counterparty behind the exposure is going through. And we should not forget to think about the opportunity that there is related to climate change. Delivering net zero transition will be incredibly hard work. CEO of Standard Chartered Bank in one of the sustainability reports from the last year made this statement. Decarbonization for banks is a huge exercise, and it's not related to the cars and business travels that our employees are doing. It's related to the emissions of banking sector are coming 95+% from our portfolios. So when we want to decarbonize, and just last week the Hong Kong Monetary Authority announced a very ambitious goal, which requires all supervised banks to decarbonize their portfolios by 2050. So decarbonization of banking portfolios is no longer a nice to have. And I'm very pleased and very supportive for Hong Kong Monetary Authority that is one of the first regulators actually pushing this. So you are really driving the scene there when it comes to decarbonization, but it will be incredibly hard work. So we'll be touching on that as well. At the same time, we have the biggest change to corporate reporting in decades arriving as we speak. The wave of sustainability related disclosures is making its way to not just banks, but also banking customers. So there will be a huge amount of inflow of information and insights that we need to prepare for. We need to connect all these elements together and thinking, how does work that we need to do for the disclosures impact all these all these other areas? How can I leverage that for my work? The greatest big data project for our bank. Head of HSBC's climate program a couple of years ago made this statement to me. Climate change is the greatest big data project for our bank. Why is it so? Where do we need to pay special attention, and what is the data side of all this meaning to us? What is our strategy? Data is a big element of climate change, decarbonization, or ESG. And if we are as a bank don't take these elements into consideration, we might be entering into a trouble. According to ECB, failing to plan and prepare for this, what everything is coming our way, is planning our own failure. That was a very strong statement from ECB recently when performing analysis on how ready the European banks are for decarbonization of the European economy, because they need to starting to prepare. So that's some teasers on different opinions on elements of climate change and the climate risk and their impact on banking customers, our portfolios. So here I will go now start with summarizing the key trends in different aspects that we have collected for you, and then we will be ready with Mick for some questions at the end. Well, let's get started. So some facts. I think everybody here on the call is aware that something is changing, right? So we don't need to spend much time on clarifying that. So the recent numbers show us that we have really reached first threshold, negative threshold in terms of temperature increase. We reached in June the 1.5 degree warming compared to pre-industrial averages. And the 1.5 degree warming is kind of a milestone set for Paris Agreement. So the idea is that we will, as a society globally, we're going to protect and try to mitigate the decrease of climate, the deterioration of climate change to a level where we will stop the global warming at the level of 1.5 at 2050. That's one of the goals of Paris Agreement, but we have breached that already now. So the climate is changing to the worse, much faster than we originally thought. Last 10 years have been the warmest on record. And this is continuously becoming the fact. Next year is again warmer and warmer and warmer. And what we see, what we want to achieve is really the certain level, to protect the certain level of warming by the year 2050. So 1.5 degree, between 2 degrees and 1.5 degrees, that's what the Paris Agreement is all about, where most of the countries around the world have committed, yes, we want to keep the global warming at that level. But it could be in the end +3 degrees, +4 degrees, especially if we don't take any serious actions now. We are more looking towards the situation that it will be +3 degrees. So much worse than it's still now. So the question is not how can we get the climate back to where it was. That's no longer possible according to the science. What we can do is, or what we are trying to do in Paris Agreement, United Nations, and all the governments is to decrease the negative impact as much as we can. So to make it not as bad as it could be. So that's where we are currently when it comes to the level of science on emissions and how we are trying to mitigate. That's what the COPs are all about, and the Paris Agreement. Now, it is not just the temperature increases that we should be worried about. You might think +1 degree, +2 degree, what is the big difference there? Those are the averages. So what we see here, for example, this picture here shows what are the average temperature differences last year compared to the period between 1990 and 2020. And what we see here is that there are certain parts of the world that have that became warmer much more than the others. So globally, on average, 1.5 degree means some part of the world became warmer by 6 degrees. Some part of the world became cooler, right? So all this changing is what we call more, rather than global warming, is global weirding. Things are getting weirder. And what does it, how does that manifest itself? It's the extreme weather events. And you are in the region that is most exposed to this extreme event. So this is an overview of total number of disasters occurring in 20 years, between 2000 and 2020. And we see countries, China, India, Philippines, Indonesia, Japan. Most of the countries here are Asian countries. So you are very exposed to these extreme events. And the problem is that with these increasing temperatures, these extreme events are becoming more frequent and more severe. So this is a result of the study from the IPCC, the Intergovernmental Panel for Climate Change, which is basically the let's say the science Bible behind all the climate discussions. And what they have analyzed is also they looked at what is the frequency and severity of extreme events going to do in world where we see 1.5 degree warming, 2 degree warming, and 4 degree warming. So on the left side, we see a typical 10-year event, which was occurring once in 10 years. So a monsoon, a very bad monsoon occurring once in 10 years. Now, according to today's studies and analysis, in a 4 degree warming world, that once in 10-year event will become happening every year. So the frequency is going to increase 10 times. So from once in 10 years to once in a year, and it will also become more severe. So that's the temperature intensity below. And we can make such connections to other events like this as well. So it's not just that it's going to be warmer, it's going to, all these bad things that are already happening in terms of weather are going to become much more frequent and severe. And we already have evidence on that from the past. So what we see on the right side is a number of $1 billion events, nature-related events in US. And they started to monitor that in the 80s, and where before it was a couple of events, 3.3 billion events in a year in 80s. Now we see 28 events like that happening every year. And those are, of course, the time-adjusted value of money, so we can compare them. So these billion-dollar events intensified and become 10 times more frequent over the last 30, 40 years. So we already see evidence of this happening. And the study of IPCC on the left side only comes on the top of this. So the Asia region is already going through a lot, but we need to prepare that this is not going to stop. this is going to be worse, and how much worse, that will depend on how much action we will take, and not just us as bankers, but it's politicians and etc. Right now, of course, from banking perspective, we need to start thinking, what does this mean for my portfolios? If I'm already struggling and experiencing losses in certain part of Philippines, what is it going to, what could this mean if in 5 years these frequencies and severities that we see here are going to manifest themselves? Those are the implications of this for our consideration as bankers. I mentioned Paris Agreement, so COP, the meeting of the all involved governments. Every year they discuss what should we do, how are we progressing. So at COPs, we had one in Dubai last year where there was a major deal on transitioning away from fossil fuels signed by almost 200 countries. And every year there is a discussion on how much decarbonization effort should we put in place. And what we see here is that the governments are mobilizing themselves, but the mobilization level is way too behind what is really required. So current commitments of governments to decarbonize and decrease the negative impact of changing climate is way below what is required to meet the Paris goals. So currently it's set, if governments would deliver what they promised, we will be somewhere at 2.5 to 3 degrees warming by 2050, which is something we don't want, right? So there is a huge push on the governments from from activists and whoever is involved in these discussions to really make a strong stand. I mean, do we want this really to achieve these Paris goals, or we should just forget it and just stop pretending that we are taking this seriously? So there's a huge political risk. That's the point why I'm bringing this up, why it's important for us to be aware of these COPs. So there is COP29 coming up in Baku, where we expect to see really some statements made on how serious are we about this? Are we going to stop it, or are we going to really switch gears and go all the way to mitigating the negative impact of the climate? And of course, what is decided at COPs in Baku or at Paris Agreement is then cascaded to the laws of our individual countries, and the policymakers then instruct the regulators to push these requirements down on banks. And in the end, we will see this manifested itself in regulation and expectation from regulators and also customers. So these decisions, political decisions, do make are relevant, are important for us to be aware of, because they have impact in the end on our portfolios and the activities that we need to perform. Example of such governmental action is, and this is happening eventually also in other parts of the world. I'm just using this as an example. So in the European Union, EU is pushing so-called Green Deal, where the European Union has committed itself to decarbonize its economy by 2050 to zero. Right. So, and to get there, we need to achieve 55% reduction by 2030. There is a set of policies in place called Fit for 55, and European Union is not going to achieve this. None of the government is going to achieve its decarbonization commitments to fulfill the Paris Agreement by installing solar panels on the building of parliament. They're going to achieve these decarbonization commitments by pushing these requirements down on those who pollute, make the pollution. So all the individual companies, and they are going to use different tools to that. And in Europe, we have, for example, laws that you are not allowed to sell any new car after 2035, which is not electric. All new houses from 2028 have to have a solar panel on the roof. And so really requirements that will influence how certain companies are doing their business. And as they are influencing those companies, then that will also influence their likelihood to repay their debts, right? And then that's what resonates for us, for the bankers. We want to understand how all these changes are going to influence the financial performance of our counterparties. That's what this all is about. So from banking perspective, on one hand, we have all these typhoons and monsoons coming in much more frequently and much more severely. So we need to keep that in mind. And at the same time, we have this huge political push, which is different in per jurisdictions, of course. EU is pushing it very much, but we see China as well taking big steps ahead. And these political decisions will have impact on financial performance of our customers. Some of the customers will be impacted more, some of them will be impacted less. And our job is to find out which ones are which. That's the purpose of climate change risk management. So one element, one aside, common tool applied by governments is carbon taxation. And carbon taxation is not a new topic. It's been around for quite some time. As a matter of fact, this inventory here shows 50 plus different regimes around the world that apply carbon taxation already. Last year, there was $100 billion collected from the taxation regimes globally. So there's a big amount of money becoming available to maybe help with climate change adaptation as well. As of now, only 20% of global emissions are covered by this taxation regime. So what we see on the chart is different regimes, and the size of the bar shows what is the average price per ton of CO2 applied by the different regimes. So we see a huge difference, right? Then there is also color, which intensity of the color, which shows how much of the emissions in the particular jurisdictions are covered by the regime. So what we can make out of this picture are three key things. Carbon taxation is not a new thing, right? It's a different form available already in lots of part of the world. Now, if we are serious about decarbonization, if our governments are serious about decarbonization, they need to apply this taxation, increase the coverage from 25% to almost 100% of the emissions, right? So as we can see, most of these regimes are covering only a small part of the total emissions. So first thing that needs to happen is this coverage will increase to 100% or close to 100%. That's one. And the second thing that we can make out of this, so when we see these horizontal bars show the price level of carbon that is expected or required for us to reach the Paris Agreement. So in order to meet the Paris Agreement, governments should think of carbon taxation as is highlighted in those horizontal bars. And if it's 1.5 degrees, we should go to almost $200 plus. And if it's the 2-degree warming goal and ambition, we are somewhere in the middle. So what we see here is that the current price of carbon needs to go much higher, right? So that's assuming the government will go seriously full speed ahead with according to Paris Agreement, which is a question mark, right? And that's the political risk here, because we, from banking perspective, now we should be thinking, if I'm going to underwrite a new $100 million loan to a big manufacturer, I need to start understanding how the manufacturing business of this counterparty is exposed to potential carbon taxation. And that depends on the region where it operates, the products it produces. And then if it's exposed to it, then I need to weight the probability that this carbon taxation will come, right? Because if I have a maturity of a loan for 20 years, over the next 5 to 10 years, there's a high probability that there will be some form of carbon taxation. So these are considerations that we need to keep in mind when underwriting loans into carbon sensitive areas. And of course, the governments are going to use also the banks and the regulators to push their requirements on the individual companies. Now, here is just a quick peek into what the companies of financial institutions around the world are doing. What are the key challenges in ESG space? We see regulatory, this is coming for Chartis research, recent Chartis research. We see regulatory compliance on the very right, of course, but that involves ESG risk assessment, the impact of operational impact of climate change. How do I bring all these discussions that we just had into my day-to-day decisions, underwriting of loans? So bringing all the key ESG aspects. I spoke about climate, but ESG is broader. Of course, there is social and other aspects as well. There is environmental, not just climate. So ESG is just a bigger umbrella, and financial impact as well. And at the start is really the collection of data. So banks are around the world are working very hard to implement all the regulations on the right side, right, and also to embed all climate and ESG related aspects into the day-to-day business as usual. And for that, they need also, of course, the data. So in terms of regulation, this has been already for quite some time. So for example, this is an example from Singapore. All the regulations have one thing in common. They are expecting climate risk to be managed as business as usual risk, right? That's all that what they have in common. In Europe, we see 2024 really be the last deadline where ECB is doing on-site inspections and putting down fines for non-compliance. So we see these requirements really entering business as usual. Business as usual, for example, also means implementing climate risk factors into our loan loss provisioning. That was a longly debated topic. How do we incorporate the climate risk factors into IFRS 9 models? So for those more technologically savvy colleagues on the call, you might remember that implementing IFRS 9 ECL models was a big change in how the loan loss provisioning was done. And entering climate risk factors into those models is starting a lot of new debates as well, because those assumptions we put into these models are going to make our P&L numbers flying up and down. So banks are very cautious, and we're not rushing too fast to do it very quickly. But regulators, especially in Europe, were very keen, saying, if you are ignoring climate risks in your IFRS 9 models, that's really the least acceptable practice that we expect. So they are pushing banks. And so this is a study for you, for your inventory, where the regulators are looking at banks, how they're in Europe, how they are actually progressing with incorporation of climate risk factors into IFRS 9 models. So there is a usage of overlay, which are more qualitative in most of the cases. And ECB has also some strong expectations on what they consider to be as bad practice and what is to be as good practice. Obviously, if you are a bad practice, you will be seeing some punishments such as fines and capital add-ons. So IFRS 9, embedding climate risk factors into business as usual, that's, for example, embedding it into your loan loss provisioning models. Second area is capital. Again, we see regulators pushing more and more with clear expectations on what banks should be doing. For example, again, in Europe, we have a guide for capital requirement models, the IRB models, which clearly says if climate factors are material for your bank, you need to incorporate them into your internal capital models. And then, therefore, there is a clear connection on the capital requirement to climate risk. So that's something that we see being kind of worked on as we speak. ECB is knocking on the door of the banks in Europe and asking, hey, what's your story here? So I expect, well, I'm sharing a lot of examples from Europe, because for some areas we see Europe is being pushing the most. For some areas it's you guys in Asia that are pushing the most. So we can learn from each other. And for example, I expect ECB to follow what HKMA has done in terms of mandatory net zero commitments for banks. And I expect also the regulators in Asia to follow some of the work that ECB is doing, because they are all connected in the NGFS organization. So if you are interested, here is a little blog I have written on the IRB models and climate risk. So I'm giving you a couple of inventories, things that you can dig deeper when after we are finished with the webinar, so you can you have some reference materials. Climate risk and model risk. This is again where the Hong Kong Monetary Authority has taken the lead, which I'm very, very happy for. So in the stress climate risk stress test in Hong Kong, the Hong Kong Monetary Authority made the explicit remark on model risk associated with climate risk models, and has required banks to demonstrate how they are managing the model risk, including understanding the impact of methodology assumption in models. Right? I haven't seen anything like that in, let's say, in other parts of the world yet, and it makes a lot of sense. And so I'm looking forward till we see that becoming the mainstream. So I'm just jumping a little bit ahead just to make sure we have enough questions. So there is a lot of debate on climate risk modeling and how accurate that can be without the right data. Another element that we see happening is, as I mentioned already, is the arrival of disclosures. So there is a huge amount of disclosures coming in. We call them, and Deloitte says, according to Deloitte, we're talking about the biggest change to corporate reporting in decades. So these are really changing the way how we disclose information on climate-related factors, and include information on carbon, climate risk assessments, net zero plans, focusing on forward-looking information. It has to be auditable, and it has, in some jurisdictions, there are even fines for the board members for failing to comply with the requirements. So there's a lot of things going on in these disclosures, but we need to understand this is not just another set of forms that we need to fill in. These disclosures require us to do a lot of things. Therefore, the corporate reporting, biggest change to corporate reporting in decades. For example, one close to you, the Australian disclosure regimes, which is following the IFRS, has been recently finalized, going live relatively soon. So I just had a look to see how extensive it is on certain key topics. So there is all in all 100 pages describing what we need to do, and the word risk is mentioned 400 times. It's risk disclosures, really. It's no longer about writing about how great our bank is, what we have done to help poor children here and there. That's topic of 10 years ago. Now it's turning really into disclose on how we are exposed to risks, climate-related risk or ESG risk, and what do we do about them? How do we mitigate emissions? How do we use scenarios? 100 pages and 100 times using the word scenario. On every single page, there is a forward-looking scenario, what we need to consider, and what is the impact on strategy. So all in all, big change there. As a teaser, there is emerging a new discipline on how to use automated technology features to process these disclosures, because it will be also our customers, big corporates, reporting these disclosures. So it's an opportunity for us as a bank to process all this new information, because we need to understand the climate risk profile, carbon profile of our customers to be able to judge what the exposure is in our portfolio. At the moment, we are struggling to get that information, but this information is going to be available in these disclosures. So there are emerging tools such as the Malena from IFC, the machine learning ESG analysis, where you can automatically process those disclosures and it generates insights for you. If you are not familiar with it, this is for free, you can play. And I invite all the banks to start thinking, what are we going to do with all these disclosures? How are we going to process it in the most efficient way, right? So this is an opportunity for us. Climate risk, the current challenges. Number one challenge, according to Chartis research in climate risk management, is compliance with stress testing. So banks have been working on the low-hanging fruits for a couple of years now. In Europe, we had 4 years to implement all the expectations. I think the Singapore one was also like that. So banks had quite some time to implement the requirements. Now they were leaving the most complicated things towards the end. So we see now banks are focusing a lot of their time now on trying to figure out how to address the climate risk stress testing requirements, and not just to execute the ones from the regulator, but to design their own processes. Number two, maybe interestingly, is financed emission calculations. The calculations of how much emissions do I have in my portfolio, not how much carbon I burn by my business flights, but how much emissions I enable by my investment, my portfolio. 95% and more of typical banks' emissions are in their portfolios. So decarbonizing our offices, it's nice, but in the end, doesn't really matter. What matters is what we do in our portfolios, right? The banks that are serious, they are decarbonizing their portfolios. That's the incredibly hard work that I mentioned earlier. I'm cautious of the time, so wrapping up. Climate risk assessments. Again, a problematic topic because we don't have data, and here we can think of also of the modeling. We don't have the data statistically to do normal models. We have been used to do PDs based on historical data. We don't have that information, so banks were struggling, reluctant to design some models or frameworks to do. ECB was clear. Taking action on limited data exposes you to risk banks. We understand, but taking no action whatsoever exposes us to even higher risk. So regulators are pushing banks to go ahead with modeling and assessments, even though there is no data yet. That data problem will be remedied by the disclosures. Here are some examples of frameworks that are being well established. So what we see with this assessment is that there is more and more kind of best practices being formed, such as, for example, geolocation physical risk assessment. So there are tools. So here's just a couple of tools that I was training the Asian Development Bank colleagues a month ago. So we are looking at different tools, how to assess physical risk in Asia. So the thing hazard, for example, is one of them. We see also more guidance coming up on the sensitivity of sectors to different hazards. So there is more information as the discipline matures. It is becoming easier for us to start, because there are a lot of things that can be leveraged. Maybe it's not fully fitting exactly but we don't need to start from scratch. There's a lot of materials and tools out there that can help us. And there are also, in Europe, for example, we have established a standard NUTS, which defines the level of aggregation that all the countries, all the banks, all the regulators have agreed upon. So there is also an opportunity for us, maybe using also ABA platform, to come together for industry collaboration and agree on certain things so we can do things together more easily. And there are more guidances coming available out there for those of you who are interested in getting more into collaboration. For example, the global credit data brought 50 banks together, and they are now benchmarking their climate risk models and approaches to the climate risk modeling. There's UNEP-FI materials providing guidance on the different aspects of physical and transition risk assessment for different sectors. So a lot of tools that was not there 3-4 years ago. 3-4 years ago, to start something like this was very difficult. Now it's still difficult, but not so much. And very proud also with United Nations, UNEP-FI banks. I'm personally involved. We are running a collaboration on identifying the best practices for climate risk stress testing methodologies. So if you are a bank part of UNEP-FI, there are 360 banks globally. So there's a big chance that you are part of it. And you would be interested to join, for example, a collaborations benchmarking survey on climate risk stress testing methodologies. Just drop me a line and I can try to get you in, because we are looking for banks that are willing to join the survey. So we we can test the range of practices applied for climate risk stress testing around the globe, and you can also benchmark your approaches with other banks. So a lot of exciting things going on. So yeah, key message, there are things that are available there for you. And just wrapping up quickly, NGFS are de facto the standard scenarios, climate scenarios. There are even numbers showing on what they expect to be the key GDP impacts from extreme weather in Asia. So you can have a look there as well. There is NGFS scenario, will be now a new version coming out of the short-term scenarios. So that's the new thing in climate risk stress testing. We are moving from only long-term scenarios to short-term scenarios. So there are short-term scenarios available from UNEP-FI and short-term scenarios from NGFS. And here is just there's just some examples. We'll see those available somewhere in the coming days. And there is a tool available for short-term climate scenario analysis, helping us to understand the impact on the short-term basis from these scenarios. And wrapping up, Scope 3 emissions, finance emission, very difficult area to master. The number 2 biggest challenge for climate risk that we saw on the chart is research, and it's just nothing else than carbon-weighted assets, where we have to look at all our exposures, all our portfolios, and understand how much emissions are embedded in our investments and loans. There are banks around there. There's a bank case study there that are increasingly bringing this together with the business as usual risk management, are using risk-weighted asset calculations to do also carbon-weighted asset calculations. So that's for inspiration, if you would be interested to see what the main banks are doing. And yeah, the transition plans, as I mentioned, becoming really must have, not no longer nice to have. And net zero is becoming really a mandatory play. Kicked off by Hong Kong Monetary Authority last week, and I expect this to be really becoming mainstream for all the other banks as well.
Thank you, Peter. Certainly food for thought, and an awful lot of information there. We have got a very lively Q&A. You got one here. Do we need to put in separate capital charge for climate risk and treat it as Pillar 2 risk charge, or can it be blanketed and covered under operational risk?
So this is not a $1 million question, but it's a hot question being debated by the regulators across the board. So first, I don't believe that we should be using operational risk capital charge for this. Operational risk is really traditionally is about the impact of extreme events on our operations, on the branches, and the flooding of our data center, and etc. Right. So there is an operational risk capital charge for the environmental impact, but the impact on portfolios that should be as the regulator saying climate risk is source of financial risk, and you should be managing it as a financial risk. That means by the impact on PDs, LGDs, EADs, and etc. So there is a debate indeed whether it should be Pillar 2 or it should be part of Pillar 1. But in Pillar 1, should it be credit risk, market risk, or should there be a standalone category for climate risk? As it stands now, the example that I shared with ECB, the IRB models, so that's what they say there. If in your credit risk capital models you see that the climate factors are being material, you should incorporate the factors into those credit risk capital models, right? So that basically answers the question, where should the climate risk land? That's one interpretation from only ECB. We don't have a statement from the regulator from a new Basel. So I expect there will be something coming up at some point, but it will take still a while. For example, now the ECB is not clear on what do we need to do in standardized approach, right? And that the IRB guide is for internal models, but it doesn't say what do we need to do with standardized approach. If the idea is let's have Pillar 1 charge as part of credit risk, then there should be a version of standardized approach saying how you should do it. And that's where I see potential for merging the PCAF, the financed emission calculations, with the ones that we have the carbon weighted asset with risk weighted assets, some kind of coexistence there. But this will take a while till it will be finalized for sure. So I don't have an clear answer for you. Sorry.
Okay, Peter, out of your top 20 trends, which do you think are the ones that you would consider to be the top 3 for 2025?
Yeah, good one. Which ones? I think that we will see the stress testing really becoming kind of much more dominant in terms of the activities that banks are doing. So the really not just listening to a regulatory call when they say, let's do a stress test, let's do it. No, but really building our own in-house capabilities and processes to run regularly in-house climate risk stress test, which is integrated with our normal stress test. So having that formalized, I think we'll see that really getting much more mature as it is now, and the regulatory push is going to help. So that I would say that will be one. This number 2 will be, we'll see, I would expect the disclosures really taking the big amount of attention of both financial and non-financial companies. So on one hand, banks finalizing the way how they disclose on all these aspects, and on the other hand, finding ways how to make use of all those disclosures that are coming they were from the corporates. Because at the moment, banks are trying to find using some ESG questionnaires, having interviews, and trying to buy information. So that those processes will have to change as the first real disclosures will be coming up. And number 3, which one would be number 3? I think I would really like to see, that's my wish, maybe not that realistic, but I would really like to see the move from Hong Kong Monetary Authority to be followed by the other regulators, to make it really clear to banks, net zero is not a nice to have. You have to decarbonize because we have to, as a society, decarbonize. Our economy needs to decarbonize. You need to push. The banks are there to push the big emitters, and we see that happening. We see banks. We have G funds, more than 500 global institutions committing to net zero, but that's voluntary. So we will have, the moment this becomes mandatory and will be tracked by the regulators, and everything is being put in place to have such process, the reporting of the financed emissions, the calculations of financed emissions. So the attention to carbon, portfolio carbon, that's whether it is, if you are at the beginning, just calculating the carbon in your portfolio, finance emission, and we should not underestimate that. I had bankers, risk managers saying, this is almost equally difficult as the risk-weighted asset calculation, right? In terms of data, engine calculations. So it's not a trivial thing. And if we want to be serious about decarbonization, we need to first start to measure it. If you want to manage something, you need to measure it, report it, monitor it, and then you can manage it. So on one hand, calculations of emissions in portfolios, and on the other hand, starting to really seriously think of how to decrease those emissions in your portfolios.
Following on from that, modeling is always it's an interesting area, and one which I think with ESG is not so easy. Getting into climate risk modeling is not easy at all. Where would you suggest banks start with that?
Yeah, we haven't spent much time on modeling today, and so we run the dedicated trainings only on that. And there's a lot of, so I kind of alluded to the key problem. The key problem with climate risk modeling, we don't have statistical data. We cannot do what we do with traditional credit risk modeling. I look at my 10 years of history of my mortgage applicants, and if Peter Plochan walks into my bank in Tokyo, I look at my history and say, hey, in my 10,000 applicants, there were 155 people looking at Peter Plochan, and on average, 10% of them defaulted. So you, Peter Plochan, without talking to you, I give you 10% chance that you will default, right? Because that's the statistics. That's in a nutshell how the traditional modeling works. We don't have that for climate. We don't have the history of companies and people defaulting because of climate-related events, because of carbon taxation. So there is a lot of place for expert judgment. So a lot of banks are struggling to how to apply this expert judgment, where to get it. And as I mentioned, regulators don't care really. They pushing banks. We know, we understand the problem with data, but we don't want you to take action. So where can we start? As I alluded, there are a number of tools already being made available. So we can start on a country level, on the industry level, to understand divide our portfolios in different buckets of sensitivities. These regions are more sensitive to physical risk. These sectors of my portfolios are more sensitive to transition risk. Once we start monitoring that, building that, monitoring concentrations, we can even start setting up risk appetite for that. We want only 5% of our portfolio to be in the most exposed sectors, for example. So we start building information on that. There are also the initiatives I would invite to, if you have the capacity, to try to team up with either the global credit data, UNEP, or here, I mean, the ABA, the association that we are taking part of right now, that's one of their key purpose, right? To bring bankers together and try to have a committee, try to see what a group of banks can think of. How would we apply expert judgment on PD adjustment on the industry level? And then you have 20 banks next to you, and each one has an approach, and then you come up with something on average that you agree. Okay, this is kind of a best way, and I'm not the only one. All the others are doing like this. So that can give you an excuse, an explanation why have you applied for a certain approach, because that's the trick. There are 25 ways how you can set up your models, climate risk models. Each will have a different impact, and you need to explain yourselves. Hong Kong Monetary Authority is asking for exactly that in that stress test. Explain the impact of the assumptions you made. So if you have kind of evidence for that coming from these discussions, that will be very helpful. And as time progresses, we'll start collecting the data. That the GCD is doing exactly that. It's pooling the data. For banks are sharing the climate default, so they can actually build the real statistical databases. It could be done also in a different platform. So maybe to summarize, really start on a high level, start simple. Don't go immediately into deep level granularity, PDs and LGDs if you don't know the difference of climate risk impact on regional and segment level. Look for the assets that you can reuse. There are a number of tools. I alluded to some. And 3, try to see if you can collaborate. Try to find some friends and work together. So we are not alone in this. And the more of us when we pull our hands together, because we should not underestimate the power we have as bankers in this, right? We have really the power to steer the carbon footprint of our customers, and it's already happening, right? So the result of this will be not only that we protect ourselves, our portfolios, we can also make some money, sell some new green products. We haven't touched much on that, but also in the end, we can help to do the good thing, right? That should be still there. I kind of downplayed it a little bit, that it was 10 years ago that we spent time writing on how great our bank is and everything. But yes, that's still there. But on the top of that, there is the business side of things. So maybe a little bit longer answer, but that's what I would suggest banks to consider.
Here's one final short one for you. Are ASEAN country banks as good as EU banks in addressing climate risks? Ignore the multinationals.
I would say that the Asian banks really understand the impact of physical risk better. The extremes, you have been around this and you have been hammered by this for quite some time. So that's what I think there the European banks can learn more. So on the physical risk side and how to manage that. Maybe on the other way, on other hand, I think Europe is pushing as a government, as a country, is pushing much more the laws and policies, which creates transition risk. So I think the European banks have been exposed to transition risk much more than you guys. So that's something that probably we can learn from each other, right? So we understand a little bit more of physical risk, and you can understand a bit more on transition risk from us. That's I will put it like that.
That's great. Thank you very much, Peter. That's been a very, very informative afternoon, and I think we're just about run out of time. So for those whose questions we didn't get to, we'll try and get to those after. But thank you very much indeed for joining, and hope you all enjoyed it.